Hello, everyone. Today on the Final Bar, I'm talking with Mish Schneider from MarketGauge. We'll see what chart she's paying attention to as this overall downtrend seems to persist. Kind of a choppy feel to today after yesterday's distribution following through on the negative movements that we saw in the last week. Today, I guess sort of a digestion day, netting out to the downside, but overall, a lot of choppiness. Stocks like FedEx up double digits, Oracle as well. Is that the end? Is that the bottom? I'm not so sure, but let's take a look at the charts together. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using data visualization techniques, the technical analysis toolkit to better quantify investor behavior and make sense of the market in uncertain times. A choppy feel to the tape today. I did a webcast earlier today on a bear market, really a market bottom checklist, looking for signs of bottoming patterns. I'm not seeing any of them just yet, is the way I would summarize the conclusion of that webcast. But we looked at some of the conditions, and it's things like improvements in breadth, it's improvements in price, it's improvements in price momentum, it's all of those different things, confirmation from different indexes. These are the tools that could have helped you in previous bear markets to recognize leading into a bear market bottom when the conditions were starting to improve and coming out of them. The challenge right now is you're not really seeing all of those, very, very few, if any of those. Now, you're seeing markets still overall in a downtrend. You're seeing random names bounce higher like a FedEx, but overall that's pretty rare. Yesterday, most notably, at one point, we had 0 stocks in the S&P 500 that were up on the day. That tells you the conditions that we are in. Not a bottom just yet, but let's keep a wary eye on the tape to see what happens. Big week this week, of course, with the Fed, which we'll certainly be talking about over the next couple of days. We have great guests on the show. I'm excited to hear Mish Schneider's take on the markets here in a few moments. Coming up through the remainder of this week on Wednesday the 15th, money manager Dana Lyons from J. Lyons Fund Management. On Thursday, the 16th, strategist Cliff Droke. Cliff is from, where is he? Cabot Wealth Network, a specialist in gold materials. Gold has been kind of a head scratcher if you're looking for gold as a safe haven. There's decent reasons why it has not been doing particularly well, but I'm interested to hear Cliff's take on it. The next couple of days after that, we'll be taking the Juneteenth holiday. I'm going to be taking a vacation, a little mini vacay with my family. So Friday, Monday, Tuesday, we'll be playing some really good special content focusing on how to upgrade your use of the StockCharts platform. We'll be back live next Tuesday, Wednesday, the 23rd. Let's continue on today's show with our market recap. Let's break down the activity in these markets using the technical analysis toolkit. I did want to start with a poll question. We asked you recently, which outcome feels more painful to you? And basically going down 50% or going up 50%, which is more painful? Missing out on a stock that has a 50% gain or holding a stock that goes down 50%? Now, what's interesting is you get a subtly different answer to this question depending on whether you ask it in a bull market phase or a bear market phase. Now they're at the time where some of us may have actually experienced some 50% paper losses at the very least. I'm not surprised to hear over 80% of you responding. That is way more painful. Now, in general, that's actually true. And there's a thing called prospect theory, which is how the pain of losses is much more negative to us mentally than the enjoyment of gains. And if you think about your investment career, you probably remember some of those painful experiences, in some ways, probably more than your exceptional wins. Because it hurts. It hurts to lose, and it hurts to hold something that's going down. It starts to see your account filled with red as you're losing money. I was taught by one of my early mentors, never let your losing trades become your investments. Another one was all long-term losses start as short-term losses. So make sure you manage your risk. And in this environment, more than anything, really good time to make sure that your stops are updated, to make sure that you're preserving cash and that you're clearly defining your exposure and your risk to different positions. Let's keep on going with our market recap. The S&P, as I mentioned, choppy day overall to the tape, with the S&P and the Dow down for the day. The S&P to around 3735, off a bit, about 1/3% lower than yesterday. The Nasdaq Composite actually finished in the green, but only by about 2.2%. So essentially unchanged, chopping around after yesterday's sell-off. Mid caps and small caps all down as well. The VIX off just a bit, just around 3240, just above there. Interest rates continue to push higher. Of course, there's an expectation that rates will continue to go higher, which I think is completely well-founded. The Fed meeting this week will most likely give us some additional detail, some additional color of what future rate hikes will look like, but also help us figure out the question mark of this week. It was not too long ago where people talking about a quarter basis point or 25 basis points, or maybe even 50. Now it's 75 and maybe 100. It shows you how people have, assumed a more and more aggressive stance from the Fed because of the rise of inflation and the lack of dissipation of inflation, if that's a way to think of it, continuing to be a challenge with the CPI number last week. So this is the opportunity for the Fed to take aggressive action. We'll see what actually happens, but I would assume that the market has not priced in enough of what higher rates actually mean, particularly in growth stocks. They've come down quite a bit, can certainly come down a little more. The dollar index, by the way, not too far higher than yesterday, about 0.2% for the UUP. Commodities, a lot of red here, particularly natural gas prices, which took a decent hit. Oil prices down as well. Energy ended up being just slightly positive for the day. Gold and silver prices were down. Cryptocurrencies, very mixed, actually. 4 up and 6 down out of the 10 most liquid coins that we track on StockCharts.com. Bitcoin down just over 1%, Ether down 0.2%, Bitcoin down in the 22,000 range after being, we've talked about the importance of the 30,000 level. In the last couple of days have really deteriorated well below those levels. This is a time to be bringing in more data and looking at the longer term trends in Bitcoin, try to identify some potential downside targets. Ether way off of a previous congestion area around 2,000 all the way down to 1,200. Let us look at the chart of the S&P 500 and see how things are playing out here. And I was just watching earlier today, Larry Williams' most recent market outlook. He published that last week, I think on Thursday or Friday. I hadn't had a chance to watch the whole thing, so I was going through it earlier over lunch. And some interesting points in there. You should check it out if you missed it at StockChartsTV.com. He was talking about some of the cyclical patterns. I don't pay a ton of attention to cycles, to be honest with you. I feel like I have enough in my toolkit to identify turning points without adding the cyclical component. Some, like Larry and others, do such a great job of thinking of that cyclicality, which is why I like watching his comments and see how they relate to my own analysis. At this point, the challenge I have with any sort of discussion of a bottom is the fact that prices keep going down. And I was taught the most bullish thing the market can do is go up. That was something Paul Montgomery, who wrote a piece called Universal Economics for years and years, legendary technical analyst, and in the institutional community had a very wide following. And that was one of the things he wrote the one time that just completely clicked with me. And the opposite side is absolutely true. Prices tend to go up for a reason. They also tend to come down for a reason. The S&P has made new lows pretty much every month in 2022, except for March, which didn't quite undercut the intraday low. But on a closing basis, we made a new closing low every month of the year, including June with the new swing lower. To me, that is a chart that is a market in clear distribution mode. And there are things I would look for. Part of it would be stop going down, make a higher low would be another a prettier way to say that potentially. And that's the thing, right? If you know Douglas Adams and some of his famous books, I remember reading in middle school. It was flying is about trying to hit the ground and missing. And I know with the markets, that is what you need the market to do: attempt to make a new low and fail to do so. That tells you that the downtrend is starting to be exhausted. You're seeing buyers that are coming in and willing to take a shot at these equities, at these ETFs, at these indexes. You're not seeing that. The last couple of days clearly showing further distribution. Closing near the lower end of the day, closing below the open, and continuing to make new downtrend. Not quite oversold as well, which suggests to me that there could certainly be some further downside to be had for the S&P. So at this point, it certainly feels risk off. The chart will tell you when it's no longer risk off, and when it's making consistently new lows. That is not the message you probably should be getting from the chart of the S&P 500. On a sector basis, a nice bright green on technology, which is a change of pace for sure. Tech has certainly been one of the weaker areas of the market, along with the other growthy sectors, but bouncing higher, about 0.2% up today. Energy up 0.2%. This is after really pushing the way down yesterday. At the downside, you have utilities, consumer staples, two fairly defensive sectors, also healthcare down, and utilities are down 2.5%. One of the indicators that I follow is the relative strength of utility. I usually plot it inversely and look at the S&P over the XLU, because when that line is trending upwards, it tells you that we're in offensive mode because the S&P is outperforming utilities. When the line is going down, the S&P is underperforming the utilities sector. To flip that over, the utilities sector is outperforming. Utilities tend to do better in bear market phases because it's a very defensive, very low volatility, fairly safe place to hide out and get some extra income as you wait for things to play out. So a little bit of a short-term reversal from yesterday's, very much risk-off feel. Just to wrap up very briefly our market recap, looking at charts like FedEx and Oracle both up today, the kicker with equities is even though the market broadly is doing one thing, the market is comprised of a number of stocks. That's why we don't say it's not a stock market as a singular. It is a market of stocks. It is a bunch of names that are aggregated into the index. And a lot of money is run certainly on index funds and index ETFs. There's a lot to be made looking at individual stocks. FedEx is compelling here only because it's found support around 195.200. That started back in March. It's continued to bounce off of that level. It's become a fairly consistent support level. We're now making potentially a new swing high now. It's trying to get above the 200-day moving average. Charts like this need to regain those moving averages to indicate a decent reversal to the upside. Let's wrap here. We're going to come back after a commercial break with Mish Schneider. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. A couple quick announcements before we get to Mish Schneider's comments. First off, we welcome your feedback and we welcome your questions. We're going to do a mailbag segment here a little later in today's show. We'll do another one at the end of the week. We'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air in our next mailbag segment. Also, go to StockChartsTV.com. That is our on-demand platform. I mentioned Larry Williams, a special event from last week. We have our latest episode of The Pitch coming up later this week, which I will be hosting, and so much great content for free every trading day at StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, a name and a face hopefully familiar to many of you because she's active on StockCharts TV, and we're very, very lucky to have her. Mish Schneider is the Director of Trader Education at MarketGauge, host of Mish's Market Minute on StockCharts TV. Mish, it's great to see you. Welcome back to the show.
Thank you, Dave. Great to see you.
So you are smiling and in good spirits, as am I, even though the markets have been deteriorating all around us. Tell us how you're making sense of things. We're starting looking at the retail ETF, the XRT. What are you seeing here?
Well, those of you who have been in the stock chart space with me know that I'm very much into the economic modern family, which is a creation of my own invention, really based on a way to tell the story of what's happening in the economy, the most salient aspects of the US economy, and then also what's happening in the market as a result. So since there's so much bad news out there, and I don't necessarily think that the bad news is going to really go away in terms of inflation and things like that, but we do know that the market sometimes is very forward thinking. And so there was one bright spot, and that's why the smile on my face, that is potentially something that we can talk about. One of the major members of the economic modern family is retail. I call her Granny Retail because I always kind of come up with the little old lady running around the mall. And so as a result of me feeling that perhaps, and of course, this is a strong perhaps, that retail can actually hold up, and particularly shocking would that be in the face of the consumer confidence that we saw last week being at record lows. It is possible that people think, even if we don't necessarily see it in the numbers, that areas of inflation have peaked. And that's why consumers are hanging on to that. And that's where we're going to see it, is in the XRT area. So right now it fell exactly to the 200 week. It's outperforming the Russell 2000, its husband, I like to say, which is already below the 200 week. And it closed green today, Dave, as you and I are talking. Now, of course, we have a long week to get through. We have the Fed, and then we have expiration, et cetera, et cetera. But if for some reason this can get back up maybe over 64 as we end the week, I would say, not that the bear market is over, but that we could actually maybe count on some kind of a rally in the rest of the market. Maybe XRT goes to 70, 75, best case scenario 80, which would probably bring the S&P up to maybe 410, maybe 415.
The daily chart of the S&P is your second chart. How is that relating to what we saw earlier?
This is the daily chart of the XRT. Well, the daily chart, of course, you can see that we have a 50-day moving average in blue that is trending down. And also, if you look at our ACP plugin indicators below, it's still in momentum, is actually doing better than it was doing, obviously, when it really sold off. But it still has a Bollinger Band that it's got to hold on to, and then a 50-day moving average it has to clear. But on the very bottom, the leadership is exactly what I'm talking about. It is outperforming the SPY. It's outperforming, obviously, the Russell 2000. It's outperforming a lot of the sectors right now. And very often, and this is why we love the Modern Family, it will give us an indication that things are changing long before not only we see it in other areas, but definitely long before we have that consensus and the herd mentality starts to shift its gears. So hopeful, like I said.
I love the Modern Family that you referred to. I know your book does such a great job describing it. And a lot of what you wrote about and talk about makes so much sense. Looking at retail, looking at semiconductors, the Russell, some really good things to pay attention to. Here we're looking at the relative strength of the S&P versus the retail ETF. How do we look at this going forward here?
Well, the green line is a 21-day moving average. And you can certainly see that throughout, really pretty much since the market fell in November, and we saw it in the retail, it's actually been climbing up in terms of the ratio against the SPX. And now it's fallen back down a little bit, even though we just saw in the leadership indicator in the plugin that it's still outperforming. So that's really what you want to see. Eventually, if XRT can actually lead, then the SPY could possibly overtake it. But it doesn't matter. At that point, its job will be done, which is to say things aren't nearly as bad as everybody likes to make it out to be. And you know how that can go. People like to be super bearish or super bullish, and we're in stagflation. And if consumers can take us and at least keep us steady as opposed to collapsing, this is where we're going to see it in the XRT.
We only have about 30 seconds left, Mish, but I did want to bring up cryptocurrencies, Bitcoin, Ethereum, others into sort of a free fall here. What's your take on what to look for in the space here briefly?
Well, I kind of tied it to XRT because we know that Bitcoin, although still trying to figure out where it is in the US economy, has a consumer base to it. And so it also is sitting right on its 200 week. And so if this cannot hold its 200 week by the end of the week, which is about roughly 22,300, then yeah, we're probably going to go back down to about 14,000, 15,000, but that too can surprise. And if it does hold, then maybe like with XRT, we can see a rally up to 27, 29, max 30,000.
Could be an interesting sign of speculation if you get a bounce in something like Bitcoin. Mish, it's a pleasure to see you and so good to have you on the show. Stay safe down there. Best to Keith and the team, and we'll talk to you again soon.
Thank you so much, Dave.
That's Mish Schneider. Mish is the Director of Trading Education at MarketGauge, coming to us from Santa Fe, New Mexico. Such a great job. If you don't understand her Modern Family she's talked about, she does a great job on her show and in her book talking about what that means. And it's looking at some what I would call sort of some key bellwether groups. Instead of looking at everything, you look at some key components. I'm wondering if there will be a cryptocurrency member of the modern family. I think she came up with it before crypto's really proliferated. I'm curious if that will happen at some point, maybe a new addition to the family down the road. But great take there from Mish Schneider at MarketGauge. Let's continue on with our next segment, the final bar mailbag. As a reminder, we are here to answer your questions and also take feedback, of course. Our email is thefinalbar@stockcharts.com. Keep the great questions coming. Let's get to question number one. When you are drawing a channel, do you draw your line across the tops and bottom wicks of the price bars? Or do you use the body of the candle, tops and bottoms? Which do you think best portrays the channel? And thanks so much for sending the link, which I'm showing on the screen now. You're referring to this period right up here, right? Which is sort of this uptrend. This is the weekly chart of the S&P 500 coming off of the low in March 2020, the spiders SPY. We then have the downtrend of lower highs and lower lows. And the question is, where do you put the channel, right? Do you put it, sort of through the lows, or do you put it at the closes? So there is much debate in the technical community about this kind of thing. It's sort of a polarizing topic that technicians would argue about at a conference, which is, what's the appropriate place to draw them. There is one school of thought, which I generally tend to abide by probably, which is to use the extremes. A lot of times when you're drawing trend lines and you ignore, highs and lows and just focus on, meatier parts of the candle, for lack of a better phrase, you're ignoring the fact that the price actually went there. It's one of the great benefits of price is that it can't be restated, right? A transaction occurred at a certain price level. That's why analyzing price can be so valuable. So if you ignore those big moves, you're ignoring the fact or minimizing what that actually meant. Having said that, the other point of view is to draw, what I would call internal trend lines that kind of cut through the price action and are, maybe better representing the bulk of the data, using closing prices and opening prices as more anchor points that better reflect the overall trend in the market. Jeff Weiss, who's come on the show before, often draws internal trend lines. You'll see it crossing, the price action is crossing through the trend line. And that's, again, a part of his process that he's developed over years and years. The challenge with that, I think the challenge with doing that, if you don't really know what you're doing, is you do what's called wishful thinking trend lines, which is a phrase I just made up, which is to basically draw a trend line that says what you want to say. The biggest challenge with something subjective like trend lines is that they are so subjective, right? If I passed out this chart to a group of 20 people, we might all draw different trend lines that best represented that analysis for us. This is why automated trend lines don't make a ton of sense. You really want to be able to draw your own representations of the trend. So that is a long-winded way of saying there are a lot of different schools of thought on this. Purists, which really go by the best practices of Edwards and McGee and Murphy and Pring and others that have come before us, really focus on the extremes, the highs and the lows. And I would start there. As you move on in your journey, you may find additional ways of thinking about it. And I would say, as long as you're focusing on key points like closing prices, I think there's still a lot of value in drawing trend lines, even if it cuts through some of the intraday price action. I just wouldn't get too loose with it, because then you're making the chart say something you want to hear, as opposed to letting the chart tell you something about the market conditions. Question number two, I don't see your chart list, random social media charts, and Mindful Investor Live chart list on my chart list, but I see the other ones. What's up with that? Great question. This is a StockCharts question. So if I go to my dashboard, which you have as a member, go to ChartLists, and you'll see I have a bunch of these. Now, some of these probably look very similar to yours because we have a series of chart packs which will automatically populate some common chart lists. And that's what I started with when I first started at using StockCharts.com more consistently. Below all your chart lists on the right, there's a little gray button that says Manage Chart Packs. And if you click on that, you'll see a number of these. A lot of the chart lists that you'll see for me are in a chart pack called David Keller's Morning Coffee Routine. We have this one, which is the Stock Chart List Framework, which is what I first installed. This gives you some starting points. That have a bunch of other ones. I've basically taken Stock Charts Essentials and some of the other ones, Arthur Hill and Carlin Aaron Swinlands, and kind of picked the stuff I really liked and turned it all into my own. So this is going to look kind of like yours if you've installed some of the same chart packs. These ones at the top are the ones that I've added to my own list of charts. Earlier, I think in this week, it might have actually been last week's show on Thursday, maybe Friday, we talked about in our Power Up segment, we talked about how to organize your chart list. I think it was on last Friday. So go back to that if you missed it. I'll show you what I do to kind of keep these on the top. And the Mindful Investor Live chart list is actually a chart list you can access. The way you do that is go to articles, go to my page, which is called the Mindful Investor, and you'll see a link to that at the top of the screen. Next question, with the ongoing electric car revolution, there are several lithium stocks that are going strong right now, like ALB, SQM, LTHM, and BYDDY. Is this a trend you expect to continue? Is it a good time to get into these stocks now or wait? Really good question. You sent this a couple days ago before things really started to roll over. So I'm curious if your question would be phrased the same way as things are going on. It's interesting. Greg Schnell comes to mind. He did a great job. He did a special on StockCharts TV a couple months ago, if I remember right, on electric vehicles. Might actually been last year. It was a real kind of big picture piece about thinking about electric vehicles, how to play them with the pure makers like Tesla, Rivian, Lordstown, some of the battery manufacturers, like some of the ones that you were asking about, lithium prices, ETFs. Traditional car makers like Ford, GM, Toyota, kind of things, and there's a lot of different angles you could play with these. The challenge I would have with these names now is not necessarily the charts themselves, but the macro conditions. The problem I would have with jumping into a name like this is the fact that a rising tide lifts all boats, is what I was told. And if we're in a risk-off environment, which I think we are, with the S&P and the Nasdaq making new lows for the year, this is not the time to be jumping into opportunities, broadly speaking. Having said that, a good chart's a good chart in any environment. What I like about ALB is a clear rotation, at least in the short term, from distribution to accumulation, lower lows to higher lows, lower highs to higher highs. I wouldn't mind taking a shot at this as long as you manage your risk effectively. And I think, stop losses and defining your risk is important in any environment, but particularly in an environment like this, where there's a lot of uncertainty, right? And there's a lot of potential movement. Out of all the ones you sent, by the way, SQM is a really good combination of long-term strength, short-term weakness, pulling back within a long-term trend, impressive relative strength. I think that's actually a fairly strong chart. Wouldn't mind having those types of names with the relative strength so strong in a time when the markets are so challenging. That is our mailbag. Keep the questions coming. We'll get to more of them later this week. We need to wrap this show, folks. Go to the 3 in 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I mentioned a webcast I did earlier today for market misbehavior. We were talking about bear market bottoms. This is one of the charts that we talked about, which is looking at the 2008-2009 bottoming pattern. A really interesting transition to look at. If you were investing at this time, you know that this V bottom was really challenging to play through and to manage through. Banks like Bank of America led on the way down, led right back on the way out for about 2 to 3 months at best. And then they were sideways as everything else started to catch up. And technology, if I remember right, was actually the #1 sector in 2009, if I remember. And I'm pretty sure that's true. But if you look, some of these other indicators tell you some of the indicators I would be looking at as the market's going lower. You need an improvement in breadth. You need improvement in not just the S&P, but in the Nasdaq. And again, technology led out of 2003, out of 2009, at least for some period of time, signaling the recovery. Small caps tend to do better. Offense over defense within consumer. Those are all characteristics of market bottoms. We have not seen any of those things materialize yet. That's why it's important to analyze previous market tops and market bottoms to help draw in some of those general conclusions. When I look at the chart of the Nasdaq, I liked Mish Schneider's take on the retail space. When I'm thinking of technology, again, I'm concerned with the downtrend. The Nasdaq the Nasdaq Composite bounced off of a 38.2% retracement. If you take March 2020 to November 2021, bounced off the 50% level and now is again deteriorating, which means the 61.8% level is the next logical step. We're not too far away from there. We're less than 600 Nasdaq points of getting to that potential support level. FedEx is the last one. Nice bounce today, and I like that. The 200-day moving average. You need charts like this to regain moving average resistance. It's been below the 200 days since last August. Can it get above there and stay there? That's a real question. It's right at Fibonacci resistance, which is a concern because that has been support before. Look at this beautiful support level around 200. What I like about this chart is the clearly defined support. Let's see if momentum can improve as well. Folks, that's our show. I want to thank you so much for joining us every weekday after the close. All of our previous discussions are at StockChartsTV.com. A special thank you to Mish Schneider from MarketGauge joining us from New Mexico. Check out her shows and her specials, Mish's MarketGauge on StockCharts TV. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.